Order. Welcome everybody. This is the Thursday evening Viper trading webinar. If you're here to learn about trading the futures market, you're in the right place. First, we have to get our standard disclaimer out of the way, so let's go ahead and take care of that. All communications from Viper Trading Systems are for educational purposes only. Futures and Forex trading does involve risk, and there is a risk of loss. Nothing contained in this webinar, other webinars, including the live trading rooms, are to be construed as investment or trading advice. And of course, everyone in here does know that you do trade at your own sole discretion. Okay, well, if there's no questions on the disclaimer, we're going to go ahead and get started. Tonight's topic is fixed targets, runners, and trailing stops. Fixed targets, runners, and trailing stops. And here's how we're going to approach it. I'm going to show a series of charts. And this is how we're going to start off, okay? I'm going to show a series of charts, and we're going to have everyone in here tonight, to the extent you would like to participate, to identify the different types of charts that we have. Okay? So let's just get started. And I'll show some different instruments. I'll take some suggestions a little bit later on instruments that people want to see. Okay? And we're going to go through the different cycles of fixed targets, what that means and how that works. Of course, runners, what that means, and then, of course, how to manage the stops. So without further ado, let's get over to a chart. Still trying to fight a little bit of this cold, so bear with me here. All right. This is a YM chart. Most of you are familiar with this. This is the mini Dow. It's one of the equities that we like to trade. It's a $5 a tick instrument. So it's a little bit lower risk than some of the other high flyers that are $10 or more a tick. And this would have been going into the morning of the 13th. Okay? Which I believe was Monday, right? So I think the 12th would have been Sunday, so this was Sunday afternoon. The market opens. Futures markets open on Sunday afternoon. You know that here in the States. And then we are going here. We're transitioning into right in here into Monday morning. Opening the market here. I'm in California. Most of you know that. California time is right down here, Pacific. So if you're in a different time zone, you would just translate that. 6:30 Pacific is the open of the market right in here. 6:30 Pacific, 9:30 Eastern. So just translate that to your time zone. We're coming into the beginning of the market here. Now, when you see a market that looks like this, right here, going into the open, would you think that you'd be trading, looking at fixed targets, A, or B, looking for runners? A, you're trading into the open of the market over here, the market's opening, that you're looking to trade fixed targets, A, or B, you're looking to trade some runners. Roger says it reminds me of today. I know, it looks a lot like today. We'll flash over to today. You're going to see a lot of similarities. Fixed targets in a range. Okay, Kenneth, good. Anybody else? Fixed, Maurizio? And Jim says, okay, fixed targets, good. No trend, fixed targets, Bob, good. Okay, excellent, excellent. All right, now let me drag this down. We're going to really try to burn this into our trading memories here, okay? So when a market, generally speaking, is in a range-bound type price action, as it was on this morning, we are going to trade looking for fixed targets. All right, that's pretty straightforward. Range-bound equals fixed targets. Now let's look at what we're talking about here. Most of you know we've done lots and lots of webinars where we show this, how to do this, but we'll go ahead and remind you real quick. You simply take a line, two lines, horizontal lines, put one down here near support, around the 340 area, put another one up here, somewhere up in here, plus or minus a few ticks. Now, second part of the question, is this range tradable? Yes or no? on this morning in particular, was this range tradable, yes or no? And bonus points if you can say why. Bonus points if you can say why it was tradable or not. In other words, what your decision making is when you look at a range to assess its tradability. Okay, we're getting some yeses coming in. Roger, Ken, Chris, all yeses. Kenneth, Maurizio, it's over 20 to 25 ticks. It is tradable. Good. Excellent. Those of you that said why, with the 20 to 25 tick minimum range, you get extra bonus points. Absolutely. All right, so here's quickly, if you're new, and we got some new folks in here, so here's how we assess this. We try to locate the support area, 340. We find the resistance area, which is up here near 65, and the difference between here is about 20 to 25 ticks, 24, 25 ticks, plus or minus, depending on how you define support and resistance. And that's sort of the lowest end of our trading acceptability, right? Because if you get much tighter than this, if you have a very tight range, like over here, for instance, it's only 10 or 15 ticks. By the time you factor in slippage, fading the top and the bottom, slippage and commission, there's just no money in tight ranges. We have to see nice ranges like this, at a minimum for tradability. Good. Excuse me, last question. Excuse me. Okay. Now, there are, Jerry asking real quick here, let me answer this question. How do you determine good support and resistance areas? Now, by the way, this question relates to another topic, Jerry, and I'm glad you brought it up, which is the instrument that you select to trade. Now, some instruments, you can see here, for instance, that this candles of this particular instrument, YM, tend to respect their support areas pretty nicely and pretty cleanly, with the exception of this little blip down here. So what we do is we find what's called a preponderance of candles, and that would look like this. Candle wicks or tops that all kind of correspond with a given area, with the exception of this little blip right here. You can see that this line, and it's not an exact science, right? I mean, support and resistance isn't as precise as people would like to think. I mean, so you've heard this before. What we like to say is something that support is an area. Okay, so there's, you would say that there's support bounded by a few ticks around 16,340. Tends to be a support area. Okay? Likewise, up here, we would say something to the effect of, it looks like there's resistance on this instrument up around the 16,365 area. An area meaning that it can go a little above it, and it may go a little bit below it. So here again, this is the notion of it's kind of an area. We tend to use a number because most people, to locate support, would need some kind of number. And that's why we use the number. But in actuality, it's an area. All right, last part on this range. Your initial entry into the trade, if you're trading this range, is it going to be to buy the bottom, or is it going to be to sell the top? Buy the bottom is A. So you'd be buying down here, buying support, fading the bottom by a few ticks. Or are you shorting the top? What is your initial entry into the range? How do you look at this range? What do you think? Selling the top or buying the bottom? Ken says both. Okay. I didn't put that out there, but I suppose you could. There's enough. This thing oscillated enough between the two overnight where I suppose you could trade both sides. Here it thrusted up. Here it was down. I'm not going to do all of them. You get the idea. Here it thrusted down. Here it did it again, again. Oh, interesting. Chris says Platinum D4, sell the top. Yeah, you do have a red mid-band. The bars are red, and it looks like kind of a red background here too. And you go into like a transitional background with yellow bars over here. Yeah. So okay. So you could be selling the top. So most of you, we got kind of a mixed bag. Most of you were saying sell the top. A few of you said both, and a couple of you, Jerry said he would be buying the bottom. All right. So as long as it's in this range, and I would encourage everybody in here that if you have not done this, to pick a couple of good instruments and find ranges like this and trade it. Hey, Balraj, some folks just coming in late. Don't worry, we're just still kind of getting started. We're only about 15 minutes into the session. We got a lot of good stuff to cover, so don't panic. And by the way, this is recorded, and we're going to put this in the subscriber area when it's rendered, either tonight or tomorrow morning. And for those of you that are on a free trial or 1-week visit, we're going to put it on the website as well. Okay? All right, good. So where we left this is, just to summarize, coming into this morning on the 13th, which was Monday on this instrument YM, is that we identified a range. We all agreed that when a market is range bound, we look for fixed targets. We're not looking for runners, right? We're taking profit at support and resistance if you're trading both sides. If you are shorting the top, of course, you're covering down here. If you're buying the bottom, you're taking profits up here and you're getting out of the trade and looking for reentry. Everybody see that? All right, now let's advance this. You can see that this happened several times. There were several trades in this range. Let's advance it. Comes down one more time. Here's you get one more shot at the buy. Right here, it comes up. You get filled. Those of you that shorted, of course, you're shorting the top. You're covering down here. Fixed targets, right? We know we've identified way over here before the market opened where support and resistance are. So we know what we're doing. We know we're not looking for runners, right? We know ahead of time because we put this right on our chart. We know our plan going into the morning. All right, let's keep advancing it. Market goes down. Market comes back up. One more long trade here to the upside, taking profits. All right, now what starts to happen right over in here? Around 7:05, 7:06. So we're a little over a half an hour into the trading session. What starts to happen here? Right over, you can feast your eyes over on the towards the right-hand side of the chart over here. What starts to happen right in here? Good. It's starting to break out to the upside. That's right, Kenneth, Jerry, Bob, Ken, Jim, John. Right. Exactly. What's happened is you can see here that a couple of critical swing resistance areas are now being broken to the upside. So the swing here was broken, as you can see, and even this little blip up over here, this swing was now broken as well, right in here. Now, most of you have heard me say this before. I'm going to explain a couple of things that are actually going on here, and so you all can, everybody can kind of soak this in. Those of you who were buying support only and taking profit at the tops would have already taken profit and been out of this trade, right? So the trade would have been finished and you would have been looking for another entry over in here somewhere, right? Those of you who were selling the top and or doing both trades, selling the top and buying the bottom, you might have had a loss on your last trade. Here's why. When you shorted here, and let's pretend you got filled on one of these bars right here. And I'm going to show you how to minimize your loss. Because here's what happens in range-bound trading if you're going to trade both sides like this. Normally, if you're trading both sides, when a market breaks out, the last trade will be a loser. But you don't have to let it be a large loser. So your initial stop on the short here would have been right up in here. You're shorting, so you'd be buying to cover. You have to go just a tick or two above the most recent swing, which would be right here. Okay? Right? See it? You go a tick or two above the most recent swing. So you're giving a little bit of wiggle room. However, what we want to do is when the market starts to move in our favor, see it went a couple of 3, 4, 5 ticks in our favor right here? When it starts to do that, what do we do with our stop? Do we leave it here? Right? You're shorted on this bar. You're short from the top of the range, and it starts to move down through the mid-band in your favor. Do you leave your stop here, or what can you do to sort of mitigate your risk? Good. Quickly move the stop down. That's right, Kenneth. Jerry. Good. Anybody else? You quickly move the stop down. Good. You tighten the stop. That's right. So when a market moves in your favor, there's a couple of places you can put that stop. Okay, you put the stop here. If you want to give it a little bit of wiggle room, that's not much. That's 6 ticks. On YM at $5 a tick, you're only risking about $30 here now. 6 ticks at $5, and you've already made good money on, arguably what, 1, 2, 3 trades. You've made as much as 14, 15 ticks. So you could be up already 40, 45 ticks. Some of you said take it to break even. You could do that, or you can go a tick or two behind break even. You have to be careful on moving it too quickly and too tightly, because there's sometimes over here, for instance, if you were filled short in here, you can see it blipped up, very quickly and check the top. So this is kind of you have to learn to feel these ranges with your given instrument. Some instruments are not this clean. All right, some of them have very jagged tops where the spikes way up here and it spikes way down there. It's not very clean, and I have to tell you, instruments like that make range-bound trading a little more difficult. Yeah, crude oil is a good example of that, Ken. Yeah, crude oil and gold, very good examples of where the ranges tend to be not so clean. They just whack way up and down. It's not very jagged, and it's hard to tell where you should be getting in and putting your stop. If you like to work with range-bound trading, try to find instruments that have clean tops and bottoms like this. Everybody see that? That's a little tip to save you some money. Just as soon as you get that market starting to move in your favor, and you feel that it's not, especially when you saw that it was turning around here, it was not following through. It should have blipped down into here and then down into here and covered you. And when it didn't start to do that and it started to reverse, yeah, you drag that stop down, let it take it out. That last trade is going to be a loser if you're trading both sides in the range, okay? Now, here's the other pattern that I teach every single webinar that we all need to memorize. It's this one right here. It's very simple. This is where a market makes a change. When it punches through a clearly defined resistance level, it's not the breakout. It's not the breakout itself. You've heard me say that 1,000 times, right? It is the retracement and the follow-through that defines the market's action. Here we see the market pull right back to prior support or resistance, and it now acts as support. This is the ceiling, holding it down, and this is the floor now. So, for instance, in the live room, you hear this all the time, right? You hear something like, that 16,365 area, that's been strong resistance all morning. I see that we've broken out here, and that should hold as support. Now, this is a important little price action to memorize, to commit to memory. Now, when I say that, I mean this. It's going to come in various forms. When a market breaks out, sometimes it will pull back a little further than expected. It might go back in like this, slightly back into the range, and then follow out to the upside. Sometimes it hardly pulls back at all. Maybe just a candle like this, and then it consolidates for a short period of time in a little range like this. These are the 3 types of breakout retracements that you normally get. And that can be breaking to the downside, or it can be breaking to the upside. It's just in reverse. So this is if you can commit this price pattern to memory after you come out of a consolidated range and you break up or down, you're going to look for how far it goes, and then more importantly, how far it pulls back, where it finds support, and then you look for a trade entry. Now, you can use entries on a pullback like this, just to show some ideas, okay? You can draw a retracement line and activate your line tool to the upside to buy. And then when that's broken, you're filled long on this candle right here. The other way to do it, if you don't want to trade the pullback, is put the buy just above the most recent swing, so when it follows through, you're filled on this candle long. Everybody see that? Ken says, I also trade NASDAQ. Is it more or less consistent with YM or about the same? They're both about the same. Now, today was a little bit different in the fact that and we'll pull up a quick NASDAQ chart in a little bit. NASI was divergent from YM, strangely enough, which is not that's not usually the case. Normally, those equities kind of stay all kind of in line with each other. You know, Russell breaks out, you know, YM and NASI follow. But lately, and I think it's the difference between how the market's trading the large caps versus the techs. For instance, if you look at the Dow today, the Dow was off 60 and change, right? By the end of the day, it was down 110, I think, at one point. So it actually had some short covering, a little bit of a short covering rally into the close. But NASDAQ closed up, I think, 3 or 4 points. So yeah, there was divergence today, and that happens. Yeah, but they're two good $5 instruments to trade with. All right. Any questions on this? We're going to move on. All right, just to recap here, what we covered. When you find that the market is in a range-bound price action, we're looking to trade fixed targets. We're not necessarily looking for runners. And we showed here how to do that and when a market changes from range-bound to trending. In this case, it was up. Here it comes up. Here you get another chance to get back in. And here it starts to head a little bit higher. So not much. You know, you had a couple little thrusts up here. You know, you had a little long pop here, and then you had a quick sort of retracement back into here. You had another chance to get long. You know, using any of the line tools here, you'd be filled on that bar long, and then you had another little pop up here. It didn't give you much, but you got a couple of trades out of it. Okay. All right. Well, we're done with that. Let's move on. Take this all off. I'm going to pause the chart for just 1 second. I'm going to pull back. We're going to look at a different day. All right, here we go. By the way, everybody sees how to handle that, right? What we do in preparation for that morning, and then how we approach it until circumstances change. You put these lines on these charts before the market opens. All right, just a reminder, those lines can make you money, right? Support and resistance, very simple. Just take a few minutes, just quickly analyze a chart and put the market on there. And I would suggest this: try not to, if you can, especially if you have a couple of screens, try to limit yourself to 1 or 2 or 3 instruments. I found that a lot of traders, especially if you're kind of, still sort of learning some of the markets, and you're trying to sort out what you want to trade and your style and that sort of thing. To just work with what you have. Try not to overtrade, and try not to put too many charts on your screen there. Now we're going to look at a different day, and we're going to look at where things change. All right. Here's another day. Here's a different day. This is a little bit earlier in January. Same instrument. We'll flip to a different instrument in a minute. All right, here's the 9th. We're going back about a week. So here's the overnight session on YM coming into the morning of the 9th. Open of the market is 6:30 right in here. So just to set you up a little bit here, you can see that in the European session overnight, all the equities on this morning, I kind of remember this, had a big shot up. And so now we're consolidating up in here, right? And I think you could pretty clearly see when you're going to define support and resistance, we're going to put a support line here around 443 plus or minus, and we can put a resistance line, up near these swings up in here, 64. So is this range tradable? You got support down here at 43, 45, and you got resistance up here at 60, 63, 64-ish. Is this range tradable, yes or no? Can you trade this range? 43, 45 to 60, 63, 64. It's kind of borderline, huh? Kind of borderline. It's about 20 ticks, but it's right on the edge. Barely tradable. Yeah, we normally say 25 to 20 ticks is the lower range. We really like, obviously, larger ranges. We prefer it to be maybe, a better range would be like 30 ticks, 25 or 30 ticks. This is sort of marginally the lower end of tradability. Roger says not for me. So yeah, some people. Now here's the thing. That I just have to put this caveat in here. Just because we said that the lower end of tradability is 20 to 25 ticks, if a range is 20 ticks or 25 ticks, that doesn't mean you have to trade it. If you're not comfortable trading that range on that market, then just wait. We all know that markets cycle between range-bound activity and trending breakout type activity. So at some point there's going to be some kind of break one way or another, yes? All right, so let's advance. Let's say maybe you took a trade or two and maybe you didn't. And we're starting to watch the market. And here we go around 6:37. So the market is open about 5, 6, 7 minutes. And we start to see this over here. What is this telling us? What is happening right there? We're about 6, 7, 8 minutes into the opening on the 9th. What's happening there? It's broken support. That's right, Roger. Chris, good. So, what did we learn from earlier? Is it the break of support or resistance that's important? Is this the important part of the move? What do you think? The break itself, is that the important part of the move, yes or no? Remember that pattern we discussed just a few minutes ago that we're all going to try to commit to memory so that we can get better with our trades? What was that pattern we talked about? No, the other one was long because, as you recall, it broke to the upside. It's the pullback. The retest, the retracement, Roger, that's right. Good. Now, if you recall from our earlier discussion, what did we say? We said that the retracement can take several different forms. This is where I think the best way to put this is we have to put our forward thinking caps on when we're looking for trading, right? A lot of traders are more sort of in, how would you say it, reactionary mode. In other words, something happens and then we react to it, right? So what we need to try to start doing, this is a healthy exercise for everyone, is to try to get into forward thinking mode. And the way the forward thinking mode is that you say to yourself, aha, I very clearly see that this support has broken. And then you think forward to yourself saying, I am expecting, if in fact this is a change in trend from up to down or to down from out of this range, I'm looking for some kind of retrace, and it's probably going to be somewhere back up into this area here. We don't know that in real time, right? When it's happening in real time and you're watching these bars form in front of your face, we don't know it's going to go back to here because it could do one of three things. It could just blast through here and go on down. That happens. It could meander around here and just kind of sit there for a couple of minutes and then break down. Or it could retrace any number of depths back up into here, and even as far as there. But what I'm suggesting to everyone in here tonight is that going forward, in one subtle thing you can do for your trading is trying to think ahead predictively. You're not trying to to so much tell the market what to do, but you're anticipating what could happen. And in your mind's eye, your trading mind's eye, you're saying to yourself, if this does this, I'm going to do this. You see the difference between that and reactionary trading, where you're waiting for something to prove itself to you, and then you take action? When you do that, you always probably find that you're sort of after the fact and you're chasing the trade. And I know that's frustrating. It can be very frustrating. That was me for many years, you know. But what we're going to do now is we're going to try to see the market is doing something, and we're anticipating it doing something else. And we're thinking ahead about the action we're going to take. Now let's go ahead, blow this up, and forward it out and move ahead the market. Here we go. What just happened right there? Let's blow this up and talk about it. Wait here, you had 1, 2, 3, 4 down bars, and you had 1, 2, 3, 4 retracement bars, and then what did it do? 1, 2, 3, 4 1, 2, 3, 4 down bars, 1, 2, 3 retracement bars, and then what did it do? This is your retracement. It rolled over and broke support. That's exactly what it did. So it did what we wanted it to do. Now, if there is enough time, sometimes these retracements take their good old time forming. I mean, it's not unusual to see a retracement come up into here and take a couple of 5 minutes or more, and you have plenty of time to draw a retracement line, you know, like this, and go in there and set your sell tool and then let it take the short. Sometimes that happens. Other times the retracement is very shallow and quick and happens in a couple of minutes. If you don't have time to draw a retracement and get filled on the rollover, which is what we prefer, because that gets you in a good place, you put your initial stop above here, and then as it moves in your favor, you trail the stop. The other way to do it, of course, is you find that swing where the breakout was, and you go a tick under it, and you short it there. Now, with these $5 instruments, YM and NASDAQ, and even the dollar index, we suggest that you try to, if your risk profile is such that you can do this, to trade 2 contracts. The reason for that is that you're trying to trade for a fixed target, and you're trying to trade for the runner. Now let's advance this chart and see what happens. Here we break down. We come down to a swing. You've already made some good money on your short here. You could peel 1 contract off down in here and set your trailing stop. Of course, your initial trailing stop is just above the swing here. You're short, so you buy to cover. You start off with 2, and if you buy to cover 1 down here, say down here at a fixed target of some kind, now you're trailing a stop on the second one, which would be right following the stop dots down into here. Does everybody see that? I would strongly urge all of you, if you want to be successful in trading the futures markets or stocks or Forex or whatever, is to try to memorize this price pattern right here when it comes out of a range, that one right there, up or down, up or down. Becoming an expert in this price pattern will put money in your trading account. It just straight up will. You know, these are patterns that we trade every day here. All right, so now we have a fixed target, and we have what? We got a runner. Let's see what happens. We retrace a little bit. Depending on how tight your stop was, you may or may not have been stopped out here. That's why we like to go a tick or 2 behind the for the loose runners, behind the stop dots. Market rolls over, comes back up, checks resistance. That may or may not have got you too, right there. Depending on how tight your stop was, that may or may not have gotten you. But you had plenty of time to take some coin down here too, right? Look how long it sat and hit this support area. Now, if you get taken out on a stop, don't panic. All right, don't panic. If you have your stop is too tight and it wicks you out and it starts falling off the map, you can simply hit market enter and short it. You can sell market, you can re-enter. You can put another sell stop below the swing and get back in. You don't have to panic and say, well, I missed the whole move. It's no big deal. You already made money on this short right here. You're just looking for re-entry. Now, let's contrast this take the right third of the chart and contrast it with the left 2/3. What is starting to happen over here? What's going on over here? Right here, the right third of the chart. Anybody? What's going on over here right now? And how is it different from over here? We are downtrending. Good, Paul, Kenneth, Roger, Balraj. We are breaking down. We are going into a downtrending market. When we are trending, what types of trades are we looking for? Fixed targets? Well, perhaps if you're trading 2 contracts or more, you could take some money on the first. Your fixed target would be the first part of the trade. However, trending equals runners. These are the days that we make most of our money in the market. Runners. Trending equals runners. When a market is trending up or down, we are looking to milk that puppy as long as we possibly can. We're going to squeeze every nickel out of that market that we can. Because you know as well as I do, good trending days don't come along all the time very often, do they? Maybe you get 1 or 2 a week. A busy week would be 3. But let's face it, most days you get a lot of this chop until it breaks. And sometimes it breaks after you're done trading. Or it runs overnight, and then you're stuck with all this. These are the days where you got to put some serious coin in your pocket. All right, let's follow this through. Here we come down, here we come down. Look at this thing drop. Just a beautiful, just downtrending market. By the way, and if you weren't in from up here, anywhere up here, all these retraces, we know. You've seen this, most of you. We like to trade the retraces, okay? You simply draw your line tool, activate the sell, and you're in. Put the stop up here near the midband. On it, you put 2 contracts on here, short. You're selling. You get a little fixed target on a target down here, and then you get your runner. Over here, fixed target at support, and then you trail your stop on the rest of it. Trail the stop on the rest of it. Good. Let's see how far this puppy dropped. Here we're at 6:30 was here. This was the open of the market. We broke down 6:40, 7 o'clock. Nice trend continuation to the downside. 8 o'clock, market's still dropping. Coming into the end of our live trading room session, 8:15, 8:30. And then, in all likelihood, somewhere down in here, no matter where you were short from, whatever level you got in, you probably got stopped out somewhere in here with all of the rest of it. Now, some of you might be saying, well, Charles, I've got to tell you something. After this thing's fallen like 30, 40 ticks, I feel like I'm trying to sell the bottom and I'm going to get stuck and stopped out with a loss. Well, the way you avoid that, of course, is you don't, and this is just a suggestion, okay? If you always feel like you're missing the run, you don't want to get in after a market thrusts down like this, right? We want the retracement. This is where a lot of traders get trapped, right? A good example, here's a couple of good examples. The market precipitously drops down to here. And this is the reactionary mode I'm talking about, okay? I want proof it's dropping. Well, there's your proof. It dropped. 28, 20 ticks. So you sell it, you're convinced it's short, and you sell it down here, and you sell near the lows. And you put your stop real tight here. And so it comes up, and it takes your stop out. How many has that happened to you? You wait to get in until it's already dropped because you're convinced that it's a downtrend now, and you sell it like right there, and your stop is right here, and it runs back up and stops you out. Does that happen to anybody? Anybody kind of stuck with that kind of scenario? Yeah? You've been watching me, haven't you? Oh, it's okay. I won't name your name. Well, it's okay. It's okay. It's okay. That happens all the time. Okay, don't. Not anymore, but I did it one time. Okay, that's good, Roger. So the way we break that habit is, of course, we have to wait patiently for these pullbacks. The retracements into clearly defined resistance areas are your opportunity to short the market. So let's not react if you're in that mode, okay, and it's okay if you are. Let's not wait till a market's already dropped precipitously and then short the bottom of it. Wait till it pulls back. Find a logical resistance area in a downtrend, and then put your retracement tools in and take the short. Does everybody see this? Does that make sense? Everybody following what we're doing here? So what we're saying is, in a trending market, we are looking for runners. We are looking for runners. Support resistance lines, Ken? Where? Right in this area right here? Sure. Absolutely. You can put support resistance lines in there. Absolutely. You can put one right, as this market was trading down into here. All right, let's say you don't have those cells in and you're watching it sort of consolidate in here. And then you had a little bit of time here. This consolidation started around 7:10, 12, 7:15, and it stayed there till almost 7:30. So there was plenty of time to put these lines in and assess the market and decide that you want to short it. You had 15, almost 20 minutes of this cycling up to here and then rolling over and cycling up and rolling over. It did it 3 or 4 times. Yeah, and you had plenty of opportunity to short here. And the beauty of shorting those retracements is that you have a very tight stop, right? You're selling up near resistance, getting filled on any one of these bars right here, and where do you put your stop? Your buy to cover stops like right here. The risk is very low. I mean, you're only looking at like 6, 7 ticks. On this instrument, that's like $30, this risk right here. Because here's the thing. If it's going to go higher and it's going to flip and take this out, so what? Let them bag the 6 ticks. That's the thing, is that a lot of traders, they'll put very wide, large stops on it, or what will happen is it'll start to chop up near your stop and you get nervous and you start to push it up, and you take something that could have been maybe like a 5 or 6 or 7 tick loss and you turn it into a 12 or 15 plus tick loss. So we got to try to get away from that. We want to try to mitigate our risk. If you got, if you got a loser, cut it short and get out. And those runners, we want the runners to run. All right, Ken? Anybody? All right, let's see where this puppy ended. I think we saw it over here, right? All right, we're short. And it bounced down here. And all right, let's do this. If there's no questions on the short side, I'm gonna ask another question over here. Take the short trades out. Take this out. Take these out. Pausing the screen. All right. Ready? Here's the end of that sell-off right down here. All right. At this point in time, is the trend still up or down? Right here, where the circle is. At this point in time, after this massive sell-off, it dropped, from 450-ish down here to 321. That's a 130 tick drop. And of course, you see the trades. You could have caught a big chunk of it here, right? A couple contracts, that could have been your trades for the day, right? Down. Okay, good. Let me advance it. How about now? Trends up or down? How about now? Up or down? I don't know. Let's see here. I'm going to draw a line here. It looks to me like some higher lows. Maybe that's a trend change. What do you think? Is that a trend change? It broke out, took out the mid-band, took out this resistance level right here, took that out. I don't know. Looks like it's breaking up to me. I think that could be a trend change Who's with me? Is that a trend change? What do you think? I'm going long. I'm hitting market buy right here. Right here on that bar. Market buy. Buy market. I'm buying in. Anybody with me? Who wants to buy it long? Right there. I'm going to get filled at 350, 348. Trend change. I'm getting long. Anybody with me? Good. Excellent. It's a 10. I like that one. The sharks are ready to eat the little fishes. Ken says it might be flipping up because the swing is taken out, but you have to wait for the retest. Good. Wait for the trend change. Not going long, says John. No. Need a retrace, says Aaron. Excellent. Balrouge, still down until it retraces and starts to go back up. Good. I'll tell you what, if there's anything you take away from tonight, of all the things we talked about, the ranges, when you go from a range into a trend, all that stuff, if you forget all of that, that's okay. If you remember this one thing, right? This is the most important thing. I'm going to advance the chart, and you tell me when you think the market trend has changed, or if it's changed at all. How about now? What is it doing? What's the market doing right now? You're watching it. And by the way, there's some time that went on here, okay? This didn't happen in like 3 seconds. You didn't have to panic. Let me just level set your time expectations here. It bounced at 8:25, 8:30, and then it went up here at 8:40, and here we're over here at 8:53. It spent 10 to 15 minutes doing this. I mean, it's not like you had to panic and hit the panic button. I'm saying you got 10, 15 minutes to watch what it's doing here, right? So that's what I was suggesting. Just relax. Just relax and watch what a market's doing. You don't have to feel panicked. Let the market do what it's going to do. Give it a few minutes to do something. Good. It's pulling back. This is the pattern we're memorizing, yes? This is one simple pattern we're going to remember when we leave here, and we're going to trade with this, right? Here's the pullback we want. Remember, we said it could go to here, very shallow. It could go to here, a little mid deeper. It could touch the prior resistance at 37. It could actually dip into here. As it's happening, you don't know, but it's coming to here. We can take our little uptrend line and extend it on out from here. We already knew when the breakout occurred where that uptrend line, we could draw it. We had 15 minutes to draw it. So we simply extend it on out. Now, if you're going to buy in, if you're convinced this is going to be a long trade, where do you get in? Need a number or an approach. Number or an approach. How would you get in? How are you getting in? Either your approach or a number. How and where are you getting in, if you're getting in? Just look at what the market's doing here. Okay, Ken says 45 on a long reversal candle and a line break. Trend line for 53. All right, so most of you are coming in somewhere in this area right here. Some of you are saying buy a breakout of here. Good. Some of you are drawing a retracement line. Maybe you're using your trend line tool, like this, and activating. This is getting really crunched. Let me blow this up there. That's a lot better. There we go. You're drawing your retracement line as it's occurring, and you activate the buy side. So when it breaks or touches, you get long, close, or you could use the close one. This is the touch. This is the close one. Good. Most excellent. Let's see what happens. Market comes up, checks that level one more time, and breaks out. So you're either long from here on the tool, or you're long on the fill on this bar right in here. Good. You can see your initial stop is going to be down here. If you're filled on the trend line tool, you're going to go just above this swing. You're long, so it's sell stop. And if you're long from here, you come down and locate the stop dot. So you put the initial stop here on this entry right here, because you're getting in a little bit later, a couple bars later. You see that? Everybody see that? 2 contracts, you're looking for initial pop, 4, 5, 6, 7 ticks. I'm off to South America. Okay. Here's your initial pop. Market pops up. Those of you that had 2 contracts, you're already banked a little coin. Market pulls back, checks your entry just by a couple of ticks. So you want to give that wiggle room. You know, a lot of you said you want to take that stop, initial stop, to break even very quickly. The issue on doing that too quickly is that a lot of times it'll come back and just check you. You've seen this, right? Or make it go a couple ticks below where you got in. Now, if you're right at break even or tighter, it might stop you out. Now, you can get back in if the market's continuing to move up, yes? Or you can let that second contract be a little looser. Here was your first. You popped the first off on that little popper right there. You're out of, that's the first, and now you got your runner. So in scenarios like this, you're actually doing a little bit of both. Range-bound action is generally denotes fixed target type trading. We all agree on that. You can trending markets tend to have you go for running trailing stop type, where you put your initial stop, and then of course you have trailing stops. And there is a slight mix of the two when you have 2 contracts, in the fact that the first pop, if you get it, tends to be for the fixed target part of the trade. 4, 5, 6, 7 ticks. Wherever there's a resistance level, you take the first contract out, and then you let your runner run with the trailing stop, which is the second contract. Okay? Let's finish this trade out and see where it went. So you got a nice follow through on this trade, right? You're trailing a stop on your runner. Here was your first contract right here. Here's your runner. Your runner's running up, running up, running up. Just a word about trailing stops. You can use the trailing stop dots. That's a perfectly good stop, and it's nice and loose. However, after a market has made a good move, a significant move like this, it tends to be far away from the price. So what we like to do is you can use a combination. Can you see the stealth line? Sometimes the stealth line is a little closer to the price. Sometimes you can have one of the bands be closer to the price. Like, for instance, here you could have followed that upper band up. Would have taken you out on this bar right here, on that second contract. This was the first part of the trade. Here was the second leg. You know, from here to here, roughly. All right, let's see, final comments. Yes, they know where the newbies have their stops. They know. Yeah, you gotta widen your stop a little bit. That's the one thing I wanted to emphasize as far as initial stops and trailing stops, and that tends to be traders who are in the early stages of their trading, or even in the intermediate stages of their trading, tend to place their initial stops and trailing stops very, very tight to the price. And the reason for that, it's understandable, is that you don't want to give up some money that you've already made. And a lot of times there's some fear of loss, and that's perfectly acceptable when you're at a certain stage of your trading. There is a fear of loss. And so, you know, you want your stops tight. You don't want to give up a lot of money. However, I think the more you trade, what you find is that sometimes if you're just a little looser on your trailing stops and some of your initial stops, that you let that market wiggle around a little bit to find its direction, and then you trade accordingly. And that just comes with the experience. That's all it is. Just takes a little bit of chart time and experience to get the feel for it. And a lot of it has to do with the instrument you trade. You know, all these instruments are not created the same, right? I mean, TF is different than NASDAQ. NASI is very different than EMD. EMD is different than ES. And, of course, crude oil is different than all the equities. In terms of the fact of how it trends, how its trading ranges play out, and how deep the retraces are. Most of you know that crude oil and gold can be very whippy. You know, these retracements, you know, these ranges are not just 5 or 10 ticks. They can be 20 or 30 ticks. Big swings up, swings down. So, you know, you've heard me say this before. Crude oil is not a market for everybody. You need to find one that works for you. Okay, Roger says, let's see here. Ken says this exercise will remind me to see the forest and not just stare at the trees. Good. Excellent. Yeah, I mean, on the surface, this seems kind of simple and straightforward, but there's a lot going on here. I think everybody sees that, right? Let's see, Roger. When the candlesticks reach those extension levels, which I watch the price action of those levels, take the first contract off at 127%. Well, you mean where you take the first contract off on a fixed target for the two contracts? That's going to vary by instrument, and it's going to vary a little bit in terms of where, if you're long, that resistance level is. And this is where you get a feel for a market's initial pop. The Russell, for instance, you might see here. Let's use an example. In this case here, you know, you got Phil long, let's say around 53-ish, right in here, and YM popped up here to 61. That's 8 ticks. It's not unusual to see YM pop 6-8 ticks off an initial thrust like that. Now, you compare this chart to the same move on the Russell, and it might be twice as much. It might be 16 or 15 or almost 20 ticks. So having an 8-tick fixed target on the Russell might be too tight. It's a function of the instrument you're trading. I guess that's what I'm saying. Okay, any other questions? Did I cover everybody's questions? Getting ready to wrap up here tonight. Any further questions on what we covered here tonight? So just to recap. Range-bound price action tends to, you're going to look for those fixed targets, and we talked about minimum acceptable ranges, 20 to 25 ticks. And here again, just because it's 20 ticks doesn't mean you have to trade it. You have to assess several things, right? You have to assess how clean the top and bottom are. Oops, what the heck is that? You have to look at many factors. It's not just the size of the range, right? How clean the top and bottom is. Is it respecting the top and bottom of the range? Is it, is it tradable? Am I going to have a nice tight stop? Is my initial entry going to be to sell the top and take profits at the bottom? Can I trade both sides? Am I buying the bottom only and taking profits at the top because it's an uptrend? All those are factors in your decision making. The runners come into play, of course, when you have a trending market, as we did over here when you went into a downtrend. That's when we start looking for the runners. And that's where we can stand on days like that to make some good coin. And then, of course, you look for natural placement of your initial stops, either at the stop dots or a nearby swing level. And then, of course, we talked about how to manage your trailing stops. That's true, Roger. Yes, the plus and minus. I suppose we take 1 minute here real quick. Go ahead and shut the recorder off. We're done